Welcome to our webinar on IFRIC Agenda decisions relating to joint arrangements. Firstly, just to explain what the IFRIC is. The full term is the IFRS Interpretations Committee, which we refer to in short as IFRIC, and it is effectively the interpretive body of the International Accounting Standards Board. Their particular mandate is to review on a timely basis implementation issues that arise within the context of current IFRSs so that they can provide authoritative guidance on how to resolve those issues. The IFRS Interpretations Committee comprises of 14 voting members that are drawn from a variety of countries and professional backgrounds, and the emphasis on the characteristics and backgrounds of these individuals is that they have practical experience in the application of IFRS. Issues that are raised to the Interpretations Committee are addressed in one of four different ways. Firstly, the result could be that an interpretation is issued, and that'll be a document with the prefix IFRIC, and that'll be IFRIC 1, 2, 3, and I think currently we're up to IFRIC 20. Alternatively, the Interpretations Committee could propose to the board that the standard itself is amended in order to resolve the issue. Thirdly, the committee could suggest that the board resolve it through the IFRS Improvements Project, which is an annual improvements project that deals with what are relatively minor changes to standards as opposed to major changes to standards. And then finally, they could dispense of an item through what is referred to as an IFRIC Agenda decision. And sometimes the dispensing of this item in this fashion could be that they dismiss the item as a non-issue, or they believe that the answer is straightforward and they provide that answer, or they believe that an answer is straightforward and they don't provide an answer. So what we generically refer to as IFRIC Agenda decisions is somewhat a loosely defined item, and we're going to talk about the ones that relate specifically to IFRS 11 dealing with joint arrangements in this particular webinar. So the question that often arises with the actions of the Interpretations Committee is which one of these actions is authoritative? In other words, which ones of these interpretations or actions are binding to a preparer of financial statements such as applying IFRS? So if you start off with the official document, which would be an IFRIC, that is certainly binding. If we look at a proposal that they make to the ISB to amend a particular IFRS standard, once that amendment is made, then certainly that change becomes binding. Thirdly, if they propose a change that occurs through the mechanism of the improvements project, that amendment will also become binding once that IFRS is amended by the board. And then finally, with respect to IFRIC Agenda decisions, the answer is somewhat unclear and could well depend on where you are located globally. In certain jurisdictions, IFRIC Agenda decisions are considered mandatory. In other words, they carry the same weight as an accounting standard, as an official interpretation, or any amendment made to a standard as a result of a proposal from the IFRIC itself. And in Europe and in the USA, for IFRS preparers in the US, IFRIC Agenda decisions are considered mandatory. You should take some time in your local jurisdiction to confirm what the standing of IFRIC Agenda decisions are in your particular jurisdiction and understand whether or not you should apply them. Notwithstanding whether or not they are mandatory, oftentimes it is good practice to apply the guidance of the Interpretations Committee in the absence of other information which you believe to be better informed or more relevant for your circumstances. Where can you find the draft agenda decisions? Well, the IFRIC meets regularly, and after each IFRIC meeting, they publish their draft agenda decisions on the items in question. And after they've received comments on their draft agenda decisions from the public, they then issue final agenda decisions, which take into account the comments that are received, which are relevant to the item concerned. Where can you find these? If you go and follow the link provided on the slide, www.ifris.org, and look on there for updates from the IFRIC and the ISB, you look for the IFRIC update, and there you'll find the history of previous IFRIC updates that have been provided, which will contain both the draft as well as the final agenda decisions made on particular issues. So with that background in mind, we'll then. So in today's webinar, as we've mentioned right at the beginning, we're going to look at the agenda decisions that affect IFRS 11, which is the standard on joint arrangement. The standard was published some time ago now. However, it has proven to be one of the most difficult standards to apply in practice. And as a result, practitioners and companies everywhere are looking for clear guidance on how to apply it practically. The IFRIC is the appropriate place to look for guidance, and they received a number of inquiries from preparers and users globally who wanted to apply the standard, but where there were differences in opinion about how certain requirements of the standard ought to be applied. And as a result, the IFRIC received these agenda requests for their consideration, and the agenda decisions we'll look at today are those that have been addressed by the IFRIC. So first of all, if we just remind ourselves about the standard itself before we look at the contentious issues that the IFRIC had to deal with. IFRS 11 is a standard that applies where investors have set up an arrangement between themselves in terms of which they have established joint control. You get two types of joint arrangements under IFRS 11, either a joint venture or a joint operation. These two types of joint arrangements are qualitatively different and have a different way of being accounted for by entities, and therefore the appropriate classification of a joint arrangement as either a joint venture or a joint operation is of critical importance. The knock-on effect of that classification is that for joint ventures, one applies the equity method of accounting as contained under IAS 28, and for joint operation, one applies a form of proportional consolidation, and I'll say a form of proportional consolidation because it in fact is a consolidation of the specific interests of that joint operator in the joint operation itself. And this will come up a little bit more in the discussion that we'll have as we address the different issues raised to the IFRIC by preparers and users. In order to address the distinction between a joint operation and a joint venture, the following needs to be considered. A joint operation is an arrangement whereby the parties have joint control of the arrangement, who have joint control over the arrangement, have got rights to the assets and obligations for the liabilities relating to that arrangement. The parties in such an arrangement are called joint operators. Alternatively, in a joint venture, the parties that have got joint control in that arrangement have rights to the net assets of the arrangement, and the parties are referred to as joint venturers. As mentioned, the accounting for a joint operation and joint venture are significantly different from one another, and therefore the distinction between the two types of joint arrangement becomes a critical issue, and a lot of the IFRIC agenda questions that were posed are to do with the matter of classification. So which items specifically was the IFRIC required to address? The first one was the classification of joint arrangements and certain issues that should either be considered or not considered in determining the appropriate classification. The accounting to be applied by a joint operator. The accounting in the separate financial statements of a joint operator of its interests in a joint operation. And then finally, the accounting in the separate financial statements of the joint operation itself. And those were the four main areas where the issues were addressed to the IFRIC for their decisions. The first one we'll look at is classification of joint arrangements. At the core of this is this extract that we've pulled from IFRS 11, and it says, an entity applies judgment when assessing whether a joint arrangement is a joint operation or a joint venture. An entity shall determine the type of joint arrangement in which it is involved by considering its rights and obligations arising from the arrangement. An entity assesses its rights and obligations by considering the structure and the legal form of the arrangement and the terms agreed by the parties in the contractual arrangement, and when relevant, other facts and circumstances relevant to that arrangement. What is often difficult to assess is what is meant by other facts and circumstances, because the rights and obligations arising from an arrangement where they arise from a contract can be directly established. Those that arise from the structure and legal form of the arrangement can also be established. The terms that are agreed by the parties can be easily established by looking at the contractual terms in the arrangement. However, it becomes very difficult to understand what elements of other facts and circumstances ought or ought not to be included in our assessment of classification. And it is specifically this matter that was posed to the IFRIC. So the practical challenge arising is when the assessment falls to an analysis of these other facts and circumstances to determine the appropriate classification, which of the views below should be considered appropriate. The first view by preparers and users was that the assessment should be based only on enforceable rights and obligations that arise from contractual or other legal terms surrounding the joint arrangement. The alternative view, view 2, says the assessment does not need to be based only on those enforceable rights and obligations, but may also include an assessment of the intent and design, as well as the business needs and commonly applied practice that relates to the joint arrangement. So as you can see, view 2 is much broader and considers elements beyond only those enforceable rights and obligations. The IFRIC responded as follows. In its agenda decision, it says a right or an obligation that is not enforceable is not a right or an obligation. Therefore, whatever other elements a reporter wishes to consider in the determination of classification under the banner of other facts and circumstances is only relevant to the extent that those other facts and circumstances give rise to enforceable rights or obligations. To the extent that these are not enforceable, these would not be considered an appropriate fact or circumstance in the determination of the classification of a joint arrangement. So this would be more consistent with view 1 as expressed on the previous slide. A further matter that arose is what precisely does it mean to have rights to the assets and obligations of a joint arrangement, which is central to the idea of a joint operation. What exactly is meant by this phrase? So with respect to assets, it means that you have rights to substantially all of the economic benefits, such as the output of the arrangement, and have an obligation to acquire all of the outputs, and thus assume the risks relating to those benefits. With respect to liabilities, it says, as a consequence of their rights, the joint operators provide cash flows used to settle the liabilities of the arrangements. So in other words, by purchasing the output of the joint operation, the joint operators essentially provide the cash flows needed to settle the obligations of the joint operation. And that also the settlement that arises from these cash flows occurs on a continuous basis. In other words, to meet the underlying going concern requirements of the joint operation. And this is how they explained how we are to understand the meaning of rights to the assets and obligations of the joint operation. Now, with this expanded explanation in hand, it then addressed a number of questions and scenarios in order to explain how one should apply this. So the first scenario we'll look at is if the parties only have an option to acquire all of the outputs of an arrangement, and in addition to this, it is highly probable based on past experience that the parties will exercise this option and indeed acquire all of the output of the arrangement, and based on the pricing of that output, will more than likely provide the cash flows required to settle its obligations. The question arising under view 1 is, because practically it is likely that the option will be exercised, this should be taken into account in determining the classification of this arrangement. The second view says, by framing this as an option, the joint operators do not in fact have an obligation to purchase the output of the joint operation. So the key emphasis here was on the structure requiring only an option to acquire all of the outputs as opposed to a direct obligation. The response of the IFRIC to this scenario was as follows. An option does not give rise to an obligation, irrespective of how probable it is that it will be exercised and that the output will be acquired, and therefore it should be ignored in the determination of the classification of a joint arrangement. So where the operators only have an option to acquire the output of a joint operation and do not have a clear contractual obligation to do so, that would not be seen as a positive indicator towards a joint operation. Another matter arising is, if the parties are required to acquire all of the outputs of the arrangement at market price, would this be a fact or circumstance that should be considered in determining the classification of the joint arrangement? The emphasis here being market price. The first view is that the fact that the price is set at the market level makes it more likely that the parties will provide the cash flows required to settle the arrangement's liabilities, therefore this should be taken into account. The second view is that it is irrelevant whether or not the selling price is the market price in terms of classification of the arrangement as a joint venture or as a joint operation. The IFRIC Agenda decision was as follows. It said, the sale of output from a joint arrangement to the parties at market price on its own is not a determinative factor. So in other words, if you're assessing a scenario and that scenario happens to refer to a market price, that would neither be a positive nor would it be a negative indicator of whether or not that would be a joint venture or a joint arrangement. What would need to be considered is whether or not the cash flows that are provided to the joint arrangement at whatever the agreed price is, whether it is above, at market, or above or below market, is whether or not sufficient cash flows would be generated to enable the joint arrangement to settle its liabilities on a continuous basis. That would be the relevant factor for us to consider. This would also not be affected by whether or not the joint arrangement has in place other funding from third parties that it is using to meet its obligations, provided that the funding from the joint operators is itself sufficient to meet the ongoing obligations. So where would this arise? This would arise in a scenario where the joint operators decide, for instance, to raise an overdraft facility in favor of the joint operation through a bank. However, if you look at the cash flows that are going to be generated by the operation by selling its output to the operators throughout the period, it would have sufficient cash flows. But they are simply using the third-party funding as a way of managing their funding costs of the joint operation. So they're not reliant on the third-party funding, but it is beneficial, and therefore they are making use of it. But it is not required in terms of making the joint arrangement financially sustainable. So that, in summary, is the decision of the IFRIC on this matter. So market price, not market price, is not in itself a determinative factor with respect to classification. Another practical challenge arising is where the arrangement produces output which is very customized to the needs of the parties, or the joint operators. Would this be a relevant factor in the classification of a joint arrangement? The implication here clearly is that if the items are very customized, then it is quite likely that the parties would have to purchase that output as no other parties could make use of it because it is highly customized, and therefore this factor should be taken into consideration. And of course, the second view would be that this is not a relevant factor to consider in terms of classification of the joint arrangement. The IFRIC Agenda decision was as follows. Whether the output that is produced by a joint arrangement and purchased by the parties is fungible or customized is not a determinative factor. So in other words, if you simply looked at that as a factor, it would neither be indicative of a joint venture or a joint operation. What is again of importance is whether or not the cash flows that arise from the purchase of that output is sufficient to satisfy the joint arrangement's liabilities as they become due. So again, the key focus of all of these agenda decisions has been, is there an obligation to purchase the output, and are the cash flows to be determined at the are the cash flows to be driven at the appropriate level, such as to satisfy the cash flow requirements of the joint operation or the joint arrangement. Another practical challenge that arose was to do with structuring. So in this scenario, it says two virtually identical arrangements. You have two virtually identical arrangements, both producing the same output. However, one is structured through a separate financial structure and the other is not. Should this make any difference to the classification? The first view is one should take into account the economic substance of the arrangement in determining the classification and not the structuring of the arrangement. And the second view is that the structuring of the arrangement is itself an important consideration in order to determine the appropriate classification of the arrangement. The IFRIC Agenda decision was as follows. The concept of economic substance means that the classification of the joint arrangement should reflect the rights and obligations of the parties to the joint arrangement. And the very presence of a separate vehicle plays a significant role in determining the nature of those rights and obligations. And therefore, it is absolutely a key factor to be considered in the classification of a joint arrangement. Moving on to the second area of decisions made by the IFRIC with respect to joint arrangements, which had to do with the accounting to be applied by the joint operator. IFRIC 11 basically says to us a joint operator recognizes the following in relation to its interests in a joint operation. The operator's share of any assets that are held jointly, liabilities that are incurred jointly, revenue from sale of output by the joint operation, and expenses incurred jointly. And in addition, it also clarifies that the joint operator should eliminate its own share of any transactions with the joint operation. Now, given that the accounting requirements that are set out here are different from those of ICE 31, the predecessor standard, there's been great difficulty in understanding at a practical level how these requirements, as simple as they might sound, ought to be applied in a practical setting. And so the IFRIC assessed a number of circumstances in order to illustrate what is required. In this first example, you have two parties, Black Limited and White, which are party to a joint arrangement, Pink Limited. The arrangement is a joint operation as each is required to purchase 50% of the output. Assuming that Black purchases its 50% for 100,000 and the profit margin is 20%, how should it account for the revenue of the output sold to it by the joint arrangement in its financial statements? The IFRIC Agenda decision relating to this scenario was as follows. It said Black Limited or White should not recognize any revenue until it sells the output to third parties. So to the extent of any items that it has purchased from the joint operation, it will not account and recognize any revenue relating to those sales from the operation to itself until such time as it has sold that same output to a third party outside of the consolidated group. So the sale of the output by the joint operation to the joint operator would mean effectively selling output to itself. And therefore, the joint operator would not recognize a share of the revenue of that sale of output by the joint operation until there is a sale to a third party. Now again, for some that might seem like a common sense answer, but for others, they would have viewed this potentially quite differently and would have recognized a sale and a cost of sale, etc. with relation to this, because the standard was not particularly clear, but the agenda decision has given us this clarity. In another scenario, you have Black Limited and White Limited, which are both party to a joint arrangement. The arrangement is one in which they both have a 50% interest in the operation. During the year, Black purchased 70% of the output of Pink, and White purchased 30% of the output of Pink at a profit margin of 10%. And the question is, how should Black account for the revenues that are so generated by Pink in its financial statements? The great difficulty arising from this scenario is that whilst the parties each have a 50% interest in the operation, the proportions to which they have participated in purchasing the output differs from that ownership interest. So Black, whilst only having a 50% interest, has purchased 70% of the output, and White has only purchased 30% whilst holding a 50% interest. The IFRIC decided as follows. It said this scenario was too complicated to be resolved by way of an IFRIC agenda. Therefore, it provided no guidance with respect to what ought to be done in these circumstances. So what does that mean for you in practice? It means that different companies are probably going to deal with this scenario quite differently. And also, it means that different audit firms are likely to also hold different views with respect to the appropriate accounting for this. So until such time as IFRIC 11 is amended by the board itself, or the IFRIC decides upon reapplication by preparers and users to deal with this matter, there is no guidance that has been provided with respect to precisely how one ought to account for a scenario such as the one we have just considered. What we'll look at is the accounting in the separate financial statements of a joint operator. The IFRIC responded as follows to effectively that question. It said, IFRIC 11 requires the joint operator to account for its rights and obligations in relation to a joint operation. These rights and obligations are the same regardless of whether separate or consolidated financial statements are prepared. Consequently, the same accounting is applied for both. This is an important move away from the accounting that used to apply in IAS 31 under the proportionate consolidation model. Under proportionate consolidation, in the separate accounts of a joint operator, it would simply account for its interest in the joint operation as a single line item. And then it would bring in the proportionate consolidation as a consolidation step in order to prepare group accounts for that operator. Under IFRIC 11, the accounting is quite different in that the separate financial statements must apply the same accounting in terms of recognizing of its share of revenues, share of expenses, share of assets, and share of liabilities in its separate accounts as well as its consolidated accounts. So therefore, there is no consolidation step between the accounts of the joint operator and its group accounts or consolidated accounts. Those will be virtually identical. And the IFRIC Agenda decision has confirmed that accounting. The fourth item for us to consider is the accounting in the separate financial statements of the joint operation itself, which we've referred to here as the investee. In this scenario, just to illustrate and create context, Black Limited and White Limited have a joint arrangement, which is Pink. The arrangement is a joint operation, and each is required to purchase 50% of the output. PINC is required by law in the country in which it operates to prepare separate financial statements. Which IFRIC standard should it apply in preparing such financial statements? So PINC is in fact the joint operation itself. So what accounting standard should it apply in preparing its financial statements? The agenda decision was as follows. It clarified that IFRIC 11 and all of the accounting that is in IFRIC 11, together with the determination of whether it's a joint venture or a joint operation, etc., only applies to the accounting by the joint operators themselves and not to the accounting of the separate vehicle, which may in this case be the joint operation. The financial statements of the separate vehicle, where these are required by law, would therefore have to be prepared in accordance with the applicable standards. For example, it could be found that the applicable standard might be IAS 27, separate financial statements, where the joint operation is carried out through let's say, a proprietary limited vehicle. There's so many different vehicles, or a trust, etc., where we still determine that that vehicle does not create for us a separate vehicle that would make it a joint venture, and it remains a joint operation. So in this scenario, you would have to apply your judgment to determine which is the applicable standard to apply for the preparation of the financial statements of that separate vehicle. However, in doing so, and in determining which assets and liabilities will appear on the separate vehicle, it is necessary to understand the joint operator's rights and obligations relating to those assets and liabilities, because it would be technically unsound for the same asset to appear both on the accounts of the joint operators as well as the accounts of the joint operation itself. And if that were possible, one would need to understand which elements of those assets and liabilities are appearing on the different financial statements of the operators and of the operation itself. So this is potentially quite a complex area, but what they've certainly clarified is that IFRIC 11 does not apply to the preparation of those financial statements by the joint operation itself. So as we said, do these assets appear on both balance sheets? Their clarification was, when identifying the assets and liabilities of the separate vehicle, it is necessary to understand all of the rights and obligations of the operators so that one can understand what is the residual rights and potential obligations that might sit with the joint operation itself and hence be recognized on its balance sheet in the appropriate form. So in summary, these are the IFRIC Agenda decisions that were made as they relate to joint arrangements. The first being relating to the classification of joint arrangements and what is meant by rights over assets and liabilities and the impact of using different structures with respect to the execution of joint arrangements, the impact of using options for the acquisition of output, and other elements that impact the classification of joint arrangements. The second area was the accounting by the joint operator itself, and this related particularly to transactions between the joint operator and the joint operation. Then the accounting in the separate financial statements of the joint operator, the clarification that the accounting is exactly identical in the separate accounts of the joint operator as they are in its consolidated accounts. There is no separate consolidation step under the IFRIC 11 accounting model. And then finally, accounting in the separate financial statements of the investee. What is most important is that IFRIC 11 does not apply to the investee. It only applies to the joint operators. Having said that, due regard needs to be taken by the investee if it is required to prepare separate financial statements of the rights and obligations of the joint operators in determining what assets and liabilities should appear on its own financial statements, in its separate financial statements. Folks, thanks very much. So again, just to reiterate, please understand that IFRIC Agenda decisions occupy a peculiar space in the world of IFRS. So they are not a standard, they are not an official interpretation. However, they express the documented views of the IFRIC committee itself. And depending on the jurisdiction that you are in, It could be that an IFRIC agenda decision is mandatory and binding and has the same standing as a standard in an official interpretation. And in other jurisdictions, it may have less of a standing. Again, as I said right at the beginning, in our own view, it is important that where it is not mandatory, you should probably take the time to understand the arguments and the guidance of the IFRIC before you determine your own accounting, especially if you decide to differ from the views that they have expressed. What is the effective date of these agenda decisions? So because they're not an official document that is issued, such as the standard on official interpretation, they do not have an effective date. So what this means from a practicality point of view is that as soon as you become aware of a particular view or interpretation of the IFRIC, in environments where it is mandatory, it becomes immediately applicable. And in environments where it is not mandatory, you may then take it into consideration in determining whether or not you're going to change your accounting policy and whether you'll do that change immediately or you might do it in some future period. And even in doing that transition to perhaps a different accounting policy, having taken into account the requirements of the agenda decisions, you also need to take into account the requirements of IAS 8 with respect to changes in accounting policies, changes in estimates, and correction of errors, and determine what is the appropriate transition from whatever you've been doing to following the guidance and the interpretation as issued by the IFRIC. For tuning into our webinar today. If you have any questions, you're welcome to submit those questions. Alternatively, if you have no questions and you want to go and access those interpretations, please visit the ifris.org website, and under there look for the IFRIC updates, and you'll see the history of all the IFRICs that have been issued, IFRIC updates that have been issued previously, and from there you'll be able to access those agenda decisions. Thank you.